Okay, let's dive in. Pretty significant news coming out of the Reserve Bank of India recently.
That's right. A big one. They've cut the repo rate by 50 basis points. It's down to 5.50% now.
And, that wasn't universally expected, was it? Seems like it caught some analysts a bit off guard.
It did. And it's the third cut we've seen since February 2025. So
That's
that adds up to a full 100 basis points reduction cumulatively. Quite a move in just a few months.
right. For anyone maybe needing a quick refresher, the repo rate, that's essentially the interest rate the RBI charges commercial banks when they borrow money short term.
Think of it like the RBI's main tool, its key lever to influence interest rates across the entire economy, if the RBI's rate goes down.
Then the banks borrowing from them pay less. And the idea is they should then pass on those lower costs to you when you take out a loan.
Exactly. Cheaper borrowing costs for banks can mean cheaper loans for customers. That's the theory.
So our mission today in this deep dive is really unpack what this means directly for your finances, your loans, savings, investments. And also look at the bigger picture for India's economy, the pros and the cons.
And it wasn't just the repo rate. We should also mention the CRR, the cash reserve ratio. RBI trimmed that too by 100 basis points, phased in, but still significant.
How significant?
Well, that move alone is expected to release something like 2.5 lakh crore into the banking system by the end of the year. That's a lot of extra liquidity.
So banks will have more funds available to lend out.
Absolutely. If you have a loan, say a home loan or a car loan, where the interest rate floats, meaning it's linked to benchmarks like the repo rate, you're likely to see your EMIs come down.
That's definitely good news. Can we quantify that? Like take a typical home loan.
Sure, let's say you have a 40 lakh home loan for 20 years. Even this 0.5% cut could mean, substantial savings on the total interest you pay over the entire loan period. It really adds up.
Okay, and you mentioned something interesting before about how to handle a lower EMI, a smart strategy.
Ah, yes. So when your floating rate EMI drops, the temptation is just to enjoy the lower payment. But a smarter move, arguably, is to keep paying your old, higher EMI amount.
Keep paying more. Why?
Because anything you pay above the new, lower required EMI goes directly towards reducing the principal amount you owe. Hit the principal harder, and you pay less interest overall.
Ah, I see. Because the interest is calculated on a smaller balance each time.
Precisely. You could potentially cut down your loan tenure by several years and save a significant amount in total interest paid. It's a powerful technique.
That's a fantastic tip. Okay, let's flip the coin. What about savers? People with fixed deposits, for instance.
Yeah, this is where the news is less positive. When banks can borrow cheaply from the RBI, they don't need to work as hard to attract your deposits.
Meaning they'll likely offer lower interest rates on FDs.
That's the usual pattern. And this can be tough, especially for, say, senior citizens who often rely on FD interest for income. Plus, there's the risk that FD returns might not even keep pace with inflation.
So your money could actually be losing purchasing power while sitting in an FD. That forces savers to think differently, doesn't it?
It does. You might need to look beyond traditional FDs. Maybe consider things like systematic investment plans, SIPs in mutual funds. They offer potential for better returns.
But with more risk, obviously. Market risk is real.
Absolutely critical to remember that. Higher potential returns usually come with higher risks compared to the safety of an FD.
Okay, what about investors? How does this rate cut generally play out in the stock market?
Generally, it's seen as a positive signal. Lower interest rates mean companies can borrow money more cheaply for expansion, operations, potentially boosting profits.
And that's good for share prices. Plus, if FDs become less attractive.
Then investors might shift money into the stock market looking for better returns. That increased demand can also push share prices up. We saw the market react, right?
We did. The Nifty 50 crossed 25,000. Nifty Bank surged. Bond markets reacted too. Yields on government bonds fell.
And interestingly, foreign portfolio investors, FPIs, they pulled some money out earlier in June, but after the rate cut, we saw quite a sharp reversal. They started investing again.
Despite maybe some concerns about high valuations in India.
Apparently so. Seems the strong macroeconomic outlook and growth potential is still big draws for foreign capital. So for investors, certain sectors might look interesting now.
Yeah, sectors sensitive to interest rates, like real estate, automobiles, consumer goods maybe, and perhaps long-duration debt funds as bond prices tend to rise when interest rates fall.
But diversification is key, always. Oh, and the rupee saw a bit of downward pressure against the dollar too. Lower rates here make rupee assets slightly less attractive for yield-seeking foreign investors.
Makes sense. So zooming out, What's the RBI's big picture strategy here? What are they trying to achieve?
Primarily, it's about stimulating economic growth. The forecast is around 6.5% GDP growth for fiscal year 26. They want to support that momentum.
While keeping inflation in check, of course. What's the inflation outlook?
Actually, the RBI slightly lowered its CPI inflation forecast to 3.7% for FY26. They cited factors like good monsoon prospects, softening global commodity prices, so they feel they have some room to cut rates without immediately stoking inflation.
So the benefit is clear. Making credit cheaper to encourage borrowing, spending, investment driving growth.
That's the aim. But there are risks, naturally.
Like what? Inflation could still pick up if demand surges too quickly.
That's one risk. Another is the potential for asset bubbles, stock prices, or real estate getting overvalued because money is cheap. And as we discussed, the definite downside for savers.
Okay, so wrapping up this deep dive. This 50 basis point cut is clearly intended as a shot in the arm for the economy. Good for borrowers, generally good for investors.
But a challenge for traditional savers relying on fixed income like FDs. It highlights the trade-offs involved in these monetary policy decisions.
Absolutely. These aren't just abstract numbers. They directly impact financial planning for millions of people across India.
It really makes you think, doesn't it? This deliberate policy choice to encourage borrowing and investment, potentially squeezing savers.
Yeah.
How will that balance ultimately shape India's economic trajectory?
And maybe more importantly, how do you, as an individual, adjust your own financial strategy to navigate this kind of shifting landscape? Something to ponder.